Now let's listen to Herb Greenberg. This is one of my favorite stock pickers and commentators out there. He's been with CNBC for years. He's now with Empire Financial Research and the Herb on the Street, his Herb Greenberg on the Street column on Substack. And I just love listening to what this guy has to say. So thanks for joining us today, Herb. And tell us lately, my friend, what's been bugging you, economics and stock wise?
Economics and stock. I'm glad you were able to narrow it down.
Yeah, you go. In fact, you go anywhere you want on that.
Oh, I could say, I could start with Twitter, but I'm not going to go there because I know that's a very popular subject with you. I'm not going to go and say that Elon Musk is bugging me because he's bugging everybody else except the people who are real fans of his. So he's bugging, say, a percentage of the population. But what is bugging me about the stock market and actually the economy? Let's talk about this because this is the issue with the are we or are we not? And we've been dealing with this now, and that is, are we going to have a recession? And I know that's a subject that's very near and dear to you. And it's something that I have written about because it's about the stock market, and it gets down to common sense. We've been talking about this now for a year and a half. Are we or are we not going to have a recession? And now it appears that we are so much closer to having a recession that everybody, again, is on that side of the boat, or they seem to be on that side of the boat. And there's plenty of anecdotal evidence that we have serious issues here.
Tell me three things, please. Three signs that the recession's imminent, because I don't see them.
I don't know. I'm not saying it is imminent because I'm saying what's bugging me is that everybody always gets into something saying we're at a certain place and we don't go there. This was one of the greatest head fakes of all economic issues. Now, I could argue, you and I both could argue different things here because I'm sitting in California and my jaw almost dropped the other day when I saw almost $7 a gallon gas. And don't go to California. Don't give me any of that. I don't want to go down that road. I like California. I like living here. Even if in Southern California here in San Diego, the weather has been pretty lousy lately for the past year or so because of something else we don't want to go to because that would bug you if I mentioned climate change. So I'm not going down that road. I'm going to just tell you that the one thing that's interesting is, I have friends in the restaurant business at the high end, white tablecloth levels with exposure around the country. And I hear business isn't doing that well. And that goes to the issue that I think Justin Lahart had laid out in the Wall Street Journal about the rich session, which we see. I travel a decent amount. I follow certain types of entities where there's travel. A lot of people definitely out traveling. I was in Europe not that long ago. It was packed where I was, but yet things were still quieter in different levels. But the one thing we all know is we all know what happens if we go to a restaurant and we see the prices, which are crazy. If we go to the grocery store, which I do, and which I am the shopper in my family, and I watch it. So we know inflation is set at a certain level on food prices, and we just don't know when and if that ever can come down because we have labor on the other side. So all of that, where does it lead? I'm no better than the next guy. And that's the point here. Think about this, Dennis. All the smart guys, everyone who's supposed to know what they're talking about, got it wrong. Which tells
they sure did, didn't they? Except for me, Herb Greenberg, who put an op-ed in the Wall Street Journal, babe. I think it was April 2022 or 2023, saying recession, what recession? The only thing is, there are some signs indeed that maybe it will yet come, right? We've got this UAW strike, Herb. We've got, 20% of our job growth is from government, the Wall Street Journal reported today, versus 5% of job growth from government a year ago. And when 20% of your new jobs is coming from government, that's spending money, not really making money. And that kind of worries me too. And then I heard there's this $400 billion shortfall in tax receipts. And aren't tax receipts from corporations kind of a leading indicator maybe of a downturn in business activity? What do you say?
Well, we have, you talk about tax receipts, and there's the additional issue that goes beyond corporations, and that goes to tax receipts in certain states like mine, where individuals have left the state, and you have that aspect, but then you have new growth. So I don't even go there. Look, Dennis, one thing I don't claim to be is an economic quote unquote guru. It's not ever been my stock and trade. My stock and trade has been stocks and more about the markets. And that gets to the other aspect of what really is bothering me, if you care, and are bugging me. And what is bugging me, and it's something I actually wrote about today in my Substack column and at Empire, because it appears both places, is it's never been easier to lose money in the stock market. It has never been easier. And it's not been easier because we keep going back to the same trough of human nature that human nature brings us to, of seeking after everything we've been through, after the last bubble, after the prior bubbles. It happens over and over again. We have thousands of stocks that trade, thousands of public companies, but people seem to want to gravitate to the same old garbage because the same old garbage seems exciting. Everybody's piling into the same old garbage. And what do we say about the economy? Everybody got it wrong, except you, of course. Everybody is in that same old boat of now wanting to find the next. I talked about this. I said, it's like we're back to the point where we're getting, the resurgence of IPOs. So we know it's going to happen there. We're going to probably have a bunch of dogs in the mix because they're going to try to push them out there. Crypto is coming back. So we're going to have some crummy coins and some cons in the mix. Not all of it, because crypto has, lots of different tentacles. But people, this is the human nature part of the markets, and people haven't learned and they won't learn yet. On the other side of it, and it's what I specialize in, is good investors, as crazy as the market structure is, as much as it's dominated by passive investors, index funds, things like that, people still can make money investing in individual stocks. They just have to be patient, and they kind of have to know what they're doing, which is the other side of it. So I do get bugged by this aspect of it, that here we are, a year and a half, 2 years after a bubble bursts, and we're back to the same old thing. And you see it coming, it's coming, but it's human nature. And I think human nature gets the best of all of us.
It does seem like a lot of investors, instead of investing in the S&P 500, they prefer to invest in the S&P 5, the FANGs and that kind of thing.
The S&P 7.
But it floods into that area.
I know.
The weird thing about that is, and I guess it's like any scam almost, is that the more that people flood into those just, 7 main doors, the more it sends prices up. And so that looks really good for a time. And then more people flood in. But then eventually, if it's up over its real value intrinsically, then it ends up coming back down to earth. And those last ones in the door get burned the worst. Now, Herb, we've got the S&P 500 up 16% year to date. We've got the NASDAQ up 32% year to date. Do you feel like those are overdone and we got to head down from there for the rest of the year, the next 3 months or 6 months?
Well, I got it wrong. And I thought we would already have really had a real ringing out, and that never happened. And so really, this really boils down to what happens, obviously, with interest rates. But even then, there are folks, there's a school of thought that if interest rates actually start to fall, if they ended up, we don't know. I don't think anyone thinks they're going to cut them right now. The question is, raising versus cutting. But if they end up cutting them, it's actually in the interim where you say, don't fight the Fed, and that should be good news. That's actually bad news, because they'd be trying to spark what some people felt that not that long ago was a struggling economy. So here we are talking about, is it an overheated economy or is it a struggling economy?
Yeah.
And you've got, again, two schools of thought on that. And I certainly am not smart enough to tell you which side will win out.
So I never let that get in the way of my going ahead and taking a guess anyway, because I'm not playing with the real money that you guys out there often are playing with. But there's something else here. You started your career as a reporter, as a journalist, as a writer, and we reporters and we ink-stained wretches were kind of raised on the idea of what's wrong with this picture, and then always looking for something to kind of go bad, and then investing at times. You've made your living trying to pick stocks that were bad, that were going to kind of head down, right? You've been,
right.
I think that partly because it's contrarian and interesting, and because, if you've got more smarts than the rank and file investor, you see more things. But then again, it's good copy to be contrarian. But I think you're also one to make sure you protect the people who are listening to you. And so you're constantly saying, look, man, I'm seeing potential downside here. Man, it's been a hard market in the last few years to be bearish or to be kind of skeptical.
Let me tell you something. As a journalist, you can look at it and say, yeah, it's splash here to do the negative. And I've spent much of my career sort of my brand is on what could go wrong. But that's because everyone's going to tell you, because again, human nature is glass half full. Someone has to always remind you that there's a risk there. Right now, arguably, that's not the most profitable way of looking at things, but the other part of it is avoiding losses. So the avoiding losses is part of the equation. I do something now.
Being rich. Avoiding losses is the true key to wealth, I think. Holding on to burned.
Yeah, it's not about shorting stocks. It's about avoiding the losses. Short sellers can profit from that much harder than they used to. I do a thing on my Substack. I currently call it red flag alert. And I say they've entered the no buy zone. And the no buy zone to me is an aspect, something people don't want to think about, is they get caught up in everything that they don't realize, hey, wait a second now. I think, in fact, it plays to the sucker mentality of investors. And I think that somebody or somebodies, and that's what the press used to do a better job of, but there aren't as many people in the press. But they still, unlike you, unlike you, who Becky Quick once called the best editor she ever had. She's told me that multiple times back when I used to be at CNBC. I tend to be more with the media than against the media. I see the flaws in the media, but part of the flaws I see in the media are tied more to a lack of bodies and a lack of this whole change and the drive for click. It used to be the drive
for clicks. Sure.
Stories that I used to always tell people, stories that I used to write, some of which maybe led to people going to jail, never would have been written today because they were about companies nobody cared about.
Huh, that's interesting. Well, yes. I've got a saying, Herb, capitalism is optimism monetized. I mean, we invest because we have hope that something will rise in value, and hope itself is a decision. And so when a person goes out looking for something, this is why you get meme stocks, right? This is why you get everyone flooding into those 7 doors. In part, it's because you go where the money is, and that's where the money is. Back to the economy for a minute, though.
Sure.
I'm thinking that the Fed will be sure to avoid recession. We'll be sure to cut rates. One reason I think they raised so furiously, they now have plenty of room in negotiating room to be able to kind of come down and give hope into the markets just in time to help reelect Joe Biden. No U.S. president has ever been reelected in a recession year. And I think the Fed will do all it can to make sure that Biden has an even chance.
Well, you're saying, it's funny. I hate to think that you and I agree on something because we are so diametrically opposed politically. I mean, in a very strong way, you and I are. The one thing we probably agree on is the politicization of the Fed, which was originally created as an apolitical body at a time when it was a very different world. We're talking a very different world when the Fed was created for its mandate to, keep prices in check and keep banks from having a run on the bank. And the one thing I think you can talk about Joe Biden here. We can go back to Donald Trump when he stood up when Powell was named Fed chair and he was his best buddy because he was keeping rates low. We can go back to Alan Greenspan when we've seen rates stay low way too long, causing bubbles basically because it created, undue optimism and euphoria. And I would say that you and I do agree that there's a politicization of the Fed, even if others may not agree. But there's no question the pressure in that job must be enormous.
Yeah. The one thing, though, let's understand that for the 8 years of the Obama administration, in the wake of that meltdown at the start of the Obama era, 08, 09, the Fed went almost the entire 8 years without raising rates a single time. Then in October, before the November 2016 election, the Fed did raise rates a quarter point for the first time. Then Trump takes over, and a month or two later, the Fed starts raising rates. I think it's a total of 7 times in Trump's 3 years before COVID came in. So Trump was trying to stoke that economic growth. It starts the first 3 years, it averages actually at some points 50% more than the previous average over the 10 years. I did a lot of this work for Lou Dobbs in his book. And incredible, but the Fed is, even though the Fed's like stoking it down, trying to stoke it down, And so it did raise rates a lot during the mere 4 years of Trump, 7 times, I think it was, versus once in 8 years for Obama, even though we were past that crisis. So they certainly have the ability to lower rates now. I really feel like the economy could absorb a certain higher rate, couldn't it? The economy can absorb. I mean, why is it that you saw the Atlanta Fed projected 5% GDP growth for the third quarter? I mean, why is it that we're growing at all when borrowing costs have been raised? The federal funds rate raised 20-fold in a year or a year and a half.
Yeah, I don't want to go down this road because we're going to rise to the level of my own incompetence in terms of trying to discuss something that I will readily admit that if I try to go down that road, because we're in a public forum as opposed to you and me just jawboning, there are people who know so much more about it than I do. And I say that as a guy who follows stocks, follows the markets, but knows darn well that most people, they're specialists and they're not specialists. And that is something I'm not a specialist in.
Let's then let's try to get ready for a dismount here and come around and kind of zoom up a little bit and just say overall going forward for the next year in stocks through the election year, which will probably have an impact on the markets. Are you feeling good or are you feeling not so good?
I'm feeling, look, folks I work with at Empire are feeling more enthusiastic than I am. I feel there has to be a step back because I think, especially we're watching some of it right now. You can see what's been going on with NVIDIA and some of the AI mess. And, I think we need to get not a reset, but I think we have to get real about some of the valuations. Some of the valuations are factoring in a future that is so far down the road that you just, normally in the course of in these situations, there is, the markets tend to take a breather. And, we've had a little bit of it, but, again, we're dominated by 7 stocks. And as they start to have, and they have had some, retrenchment, I think that's good. Anything going up in a straight line is not a good thing, Dennis, because it sucks everybody in and people start feeling good again. I will say the one thing about what's been going on that is fantastic is that savers have had their day, and savers it's the revenge of the savers. And it's great to see
rates have gone up, and now they're finally getting good rates.
That's the other part of it. When you were sitting there with 0% rates, and in a sense, the government, the Fed, whoever you want to say, was forcing people who shouldn't take risks to take risk or to feel like chumps. That was not a good situation because we talk about stocks, but we don't talk about everybody else. And there are a lot of people out there who have a lot of money in cash, had a lot of money in cash, and we're making nothing on it. And that was a hard time. Now, at least
5%
that part of the equation has changed.
Yeah, 5% can be a huge difference versus nothing.
550 is even better. And I have some of those.
Take it where you can get it. All right. Thank you so much for being with us today, Herb Greenberg. I love you, man. You're looking awful good. And we appreciate your comments. I hope you'll come back, visit us again. Sure. Okay.
Anytime.
Ricochet. Join the conversation.